All right. Hope everyone enjoyed lunch. Those of you online, put in the chat if we're having technical difficulties. We'll adjust. This is the Real World Asset Tokenization panel, and we are joined. I'm your moderator, Ben Melnicki. I'm the Chief Risk and Compliance Officer at Cross River Bank. We are a New Jersey state chartered institution regulated at the federal level by the FDIC, and we bank a lot of the leading players in the crypto ecosystem. We also have the technology core that helps power some native digital asset activity. And so I'm actually very, very honored to be here with this esteemed panel. We've got a lot of industry expertise here. To my left is Nitin Gore with Nevermind. I'm sorry, it's Justin Schmidt. Justin's held several key roles. That's why they say pivot. Several key roles at places like Goldman Sachs, where he led the digital asset practice, and most recently in Ondo. Then we got the great Alex Zozos, who's currently the general counsel over at Superstate. Also has tremendous experience from prior stops at Coinbase and in government with the SEC. So we get different perspectives here. And finally, last but certainly not least, Tom Sullivan, who heads digital assets for DTC. And as we go through this panel, I think you'll learn about the way that we curated the panels here, from different activities within the tokenization space. So hopefully it'll give you a broad swath of activity that's going on. So with that, I want to start, I think rather than just giving bios and them telling you what they've done in their careers, which I basically just did, I think it would be helpful for each of them to tell a little bit what their companies and their past experiences are and current in tokenization. So I think Nitin, you're next to me, you go first.
Thank you so much, and so glad to be here. Thanks to Delaware, and thanks for University of Delaware for setting this up. Always engaging conversation. Let's say next IBM, ex-State Street, I have spent a lion's share of my career in building infrastructures. And my work now with Nevermind essentially is building the resilient infrastructure of tomorrow. So purely, I'm a preeminent engineering firm. We have 350 plus engineers. We are tackling tough problems like formal verification, post-quantum cryptography, all the things that are needed to make sure that financial industry is comfortable in doing business on public infrastructures, public blockchains, in a compliant, resilient manner. And so in addition to that, I have privilege of working with the likes of Tom at DDCC and some of the largest financial institutions as the advisor. So I'm heads down and figuring out as to, one, how do you make sure the infrastructure is resilient and compliant in today's standards, but also how do you protect that infrastructure from financial stability perspective for tomorrow's workloads as these new financial structures move on chain, what is needed. That's sort of my role in that context. So glad to be here and looking forward to this engaging conversation.
Great. I'm Justin Schmidt. My new company has nothing to do with tokenization, so I'm going to talk about that. But back in 2018, I was hired by Goldman Sachs to help out their very nascent digital asset team at the time. The major sort of thing we did there was an actual tokenized bond issuance on public Ethereum with two other banks, and the client was the EIB, which is a major institutional partner for all three of the banks. More recently, I was president at Ondo Finance. Ondo Finance is a technology platform for tokenization. Ondo is the leader in both tokenized treasuries as well as more recently tokenized stocks. I'm sure we'll get into more of that later. So over to you, Alex.
Alex Zozos here, currently general counsel at Superstate. Give a little background on Superstate and what we're looking to achieve. Our roots are in DeFi from our founder, Robert Leshner, who created Compound, which was one of the first decentralized lending protocols. But one of the limitations with DeFi as it exists is the quality of the assets that are eligible and able to interact with these financial primitives. So came and founded Superstate. We dog fooded a few tokenized fund products, one of those being USTB, which we grew over to over $1 billion, and we just helped transition over to Invesco, who's going to take over as the investment manager for that. But really demonstrating that you can tokenize equity on chain, and then you can get a lot of the function and utility with that. Where Superstate is going and what we've demonstrated by tokenizing the equity of Galaxy and other operating companies is working as the connective tissue between, what DTC operates and the on-chain markets themselves through a form of direct ownership, serving as a transfer agent and working as an agent of these issuers to provide a blockchain integrated record keeping system. So we're continuing to move that forward. Very excited to grow that and work with, industry incumbents and newcomers to the space to serve as that connective tissue and bridge.
Good afternoon, everybody. I'm really glad to be here. Apparently, there was some Kalshi bet as to whether or not I was going to show up on time, so I made it.
We don't prefer any one platform over another, but yes, there was a market. There was a market.
So, as Ben said, I lead digital asset solutions at DTCC. For those of you who are unfamiliar, DTC is the largest securities depository in the world. We manage the assets primarily on the equity side for largely the U.S. market, and we operate a closed system. So it's interesting in some ways that some people might wonder, and I think this has happened over time, why is DTCC doing this? And the reality is that we recognize that this technology is a way to transform the markets. We've been a leader in transforming the markets for the past 50 years, and we're looking to continue to do that. So my background, I actually ran payments and securities operations at large financial institutions, most recently at SocGen. And we started exploring digital assets really 10 years ago and really building towards this real-world solution. So whether it be using Paxos, which did the first equity tokenization probably 8-9 years ago, or Broadridge's DLR platform, where we're able to manage our repo portfolio through a blockchain solution. And then I moved on to lead digital assets overall for SocGen in the United States, where SocGen has a division called SG Forge. And SG Forge has built a real strong play in terms of developing assets natively on chain. So I have a bit of a background in both the traditional world and the way we're going. So I'm looking forward to the discussion.
Right. So I want to talk a little bit of history. We're at the University of Delaware, so there's the teaching element to this here. Full disclosure, I forgot to add, I am an alum of the University of Delaware, so it means there's a lot to be back here. Alex, I'm going to start with you.
You missed that.
I missed it.
We didn't discuss it. Prep calls. You should start the whole thing with that.
I want to bury the lead. So, Alex, I'm going to start with you. I think one of the things that strikes me is you are somewhat of a historian about financial markets. And I think for those of you who've been working in or with blockchain technology for many years now, I feel like real world assets started long ago with the rights to diamonds on the blockchain. But it feels like right now we're at an inflection point, Alex. I think the market is real. There's real use cases and activity. Can you sort of walk us through in a non-lecture hall kind of way, but real succinct on where you think how the market's evolved and where we are today?
Sure, yeah. I'll try and do that as quickly as possible, but no, I mean, I think markets in general are reflective of the technology that's available at the time. I think Tom spoke to the fact that DTC has been this very systemically important infrastructure for handle, and there's a few interwoven pieces that DTC operates from NSCC and DTC and handling both the clearing and the custody of the securities, but that was really a function of history, right? I mean, the Uniform Commercial Code was updated to accommodate DTC, which was really an outgrowth of the failure that arose out of the paperwork crisis in the late 70s and early 80s. And at the same time, the 75 amendments were coming out, talking about the creation of a singular national market system. And so what happened was there was some proposed solutions on how to fix what the paperwork crisis was, which was essentially people were trading a lot more often, but it was very difficult to transact the paper certificates at as fast of a pace. And, Chair Atkins has talked about this a few times, but, a number of brokers went out of business because they couldn't make delivery on time. The markets were shut down for a handful of days. I think Wednesdays they were closed. And so one of the solutions was, hey, let's have a transfer agent network called TADS, which would have helped facilitate the settlement of securities. And another solution was what came to be DTC, which was essentially let's put everything in one big box. And if we keep everything in that box, then we don't have to move it around as much. Obviously, the DTC has grown, and as Tom has mentioned, handles quadrillions of transactions on an annual basis. But it still is a function of the technology that was available at the time. And so maybe we're looking to potentially move that forward, and is an indirect ownership structure. And so there's some pros and some cons to that. But yeah, I mean, that's kind of like how we ended up where we're at today. And I think Tom's looking to update the system from within. We're looking to potentially provide some resilience by some alternative means of allowing for self-ownership or direct ownership. But yeah, I think that's kind of how we ended up here, which was there was a market failure, there was a response to that, and now there's a new technology that's being adopted and looking at the best ways to integrate those.
Yeah, thanks. So I guess, question to the future. I mean, Tom, DTC, from your seat, I mean, look, there's institutional adoption. Like, what are you seeing in, like, where we are now from your seat? DTC plays a critical role. I mean, you're clear. I think, remember you mentioning to me once we cleared something like
$4 quadrillion worth of securities a year.
I didn't even know if it was try something, but thank you. So,
And I looked it up. We process about 390 million security messages a day as well. 390 million transactions per day.
that's the quadrillion thing has me. Thank you.
Lots of zeros.
Yeah, I mean, so what do you think, flashing forward, institutional adoption? Like, what does that mean? How are you seeing? Because you're a member-driven org. Where are you seeing a lot of the demand, and I think the opportunities just from your seat?
Yeah, absolutely. So and maybe if I just take a little bit of a side trip to why we're doing why we're able to do what we're doing. So at the end of last year, DTCC received a no action letter from the SEC, which effectively enables us to open up the assets that sit within the depository to make them available to be tokenized by our members for the benefit of our members and their customers. And really what that's doing is moving from the closed system that Alex was describing to more open networks to be able to leverage the tools and improvements that you get from these open networks. That could be in terms of resiliency. So in other words, DTC manages a number of data centers, all of the data, so the 390 million transactions, the $4 quadrillion worth of securities is managed within data centers that we control. And so using decentralized systems that have greater resiliency is obviously a potential benefit. And that, I think that the market recognizes that for one, but that's not really a primary driver. I think that it's more using technology that has the capability to build in rules-based actions, meaning leveraging smart contracts so that you can automate activity, number one. Number two is that we are moving to a 24/7, 365 world. So the US equity markets will be moving to 24.5 more or less. So there's a minute between or something like that, but more or less 24/5. And so there's also, I would say, a clear, and this is something that I've been talking about for a while, and something that we expected to happen, both at DTC and I think others in the space, is a convergence between traditional markets and traditional finance and crypto markets. And you take the good that happens, the benefit that happens with crypto markets, meaning real-time activity, more visibility, limited to no downtime, and also, the ability to automate those transactions. So concretely, one of the key use cases that we're hearing a lot from our clients is with respect to collateral management. So how you take assets that you have other types of transactions, whether it be repo or equity swaps or derivatives transactions, where you need to post collateral either to an exchange or to other counterparties, and using blockchain technology and blockchain rails to move those assets more quickly in more real time is one of the real compelling use cases that we're seeing lots of traction for.
Thanks. Justin or Nitin, I want to just see if you guys want to give you a chance to add anything in terms of what we're seeing.
I don't want to add. I think you were quite eloquent. I just think that the industry has in general has underestimated. This is my work, both I built the old system when I was at IBM. This is the old transaction system, the data centers that you talk about. And now when we look into digital assets on blockchain, I think there's a significant mismatch in modality of the assets and the systems that are behind the scenes doing the reconciliation, doing the asset movement, all the stuff that the DCC does in general. And I think the work that you're doing, and of course the work that crypto industry doing from a superstate perspective, for that convergence to happen, I think it's a Herculean task going forward, because there's just a mismatch of velocity of assets, which creates interesting, because the risk model that we have, I think, from today's systems perspective, I think there's a fixed construct of settlement, which is the ultimate finality, the UCC8 that you talk about, which is the ownership change, the legal finality of these things. And I think that for us to shift from that model where this fixed construct has legal finality, has netting, has settlement, has the definition of settlement, shifts that model when we move towards a blockchain way of settling things, which is more towards atomic DVP, getting into this new smart contract-based model that, Tom, you talk about. So there's a significant shift and change in the way we look at things like UCC8. We look at good control location, who really controls the asset, and those are a hallmark of our financial system to maintain the financial stability that we rely upon. So I think there's this conversation, hopefully by the end of this, which is your task, we want the audience to understand that shift that's happening and what the industry, both from market structure and market infrastructure perspective, address. I'll pause here. Say something.
Nothing on that one, at least, right, Justin? So, interesting. We are at a conference where there's some regulators in the room. I think people are interested in policy. So I want to shift gears a little bit. Alex, I'm going to start with you. We read in the news a lot more about tokenizing U.S. equities and that market developing. I think there's still work to be done, and we'll get to it in a moment. I think I want to hear from you guys about what some of the U.S. markets regulators are doing, which is pretty exciting. But what are the key differences in some of what the token represents versus the stock, and what legal recourse do investors have to the issuers and vis-a-vis each other? Just sort of, if you can just, I think break it down on a more granular level about what that means when we say tokenizing Apple. I think it'd be helpful.
Yeah, and I think maybe others can speak more deeply on potential models that they support. But maybe we do that. I'll just talk about issuer sponsored security entitlements, and then you can talk about like the Ondo approach as well, which is a derivative. I don't how you want to describe it. But like the issue in the U.S., there's an issuer sponsored model. I kind of previewed that, which is essentially we as a transfer agent serve an issuer of securities. Issuers have an obligation to maintain books and records of their underlying holders. And so what we do is essentially hold a blockchain integrated record keeping system. So we associate a person with a wallet and create a security on chain or an instruction token, which essentially entitles you to all of the rights of being the owner on the books and records of the issuer. So essentially, the issuer has full visibility. It's a direct ownership structure. We serve as an agent of the issuer, and that can lead to some great efficiencies from regard to corporate governance. It also allows for potentially much easier capital formation because you can directly sell your shares to your underlying holders. One of the limitations that Tom kind of touched upon is the scalability of this model. Needing to go issuer to issuer obviously takes time and could be a zero start problem where if there isn't enough there, with regard to tokenized securities, maybe there isn't enough of an attraction to move to that approach. So that's the issuer responsive model. Superstate is doing that. Securitize does something similar to that. Maybe you want to talk about, or you want to, sure.
Go ahead. I'll go ahead.
Yeah. So I think that's broadly speaking, even we look at the markets and we say that this is an opportunity, even to the earlier questions of why things are happening. There's an opportunity for choice, how investors make investments, as Alex said, to have their benefits to the direct registration model. It actually exists today. You can go to it, we can help people do that. 99 point something percent of the market is not that way. And historically, it's been cumbersome, but certainly you can see some clear benefits to that. On the other hand, this really both a practical piece and then a market structure piece is that from a practical matter, we're sitting on, I'll use another number, we're sitting on 100 trillion worth of assets in our depository. So when we can make those assets available, we tokenize, it really opens the gates in a way that you can't do by doing one by one. And so that's kind of, that's one piece of the puzzle, but also through keeping the indirect holder model enables the real fungibility, meaning that the entitlements that the person has on chain is the same entitlements that they have through their broker-dealer today or through the closed system that we operate at DTC. And so it enables the real seamless fungibility between if there's a market on chain or if there's a traditional market that's trading the asset where you can maintain the liquidity. And that's important not only for trading markets, but also for lending markets as well. And so that's really kind of, why we see the, going down this road rather than trying to effectively go back to where we started 50 years ago, which was to have the transfer agents manage those direct relationships. That said, as I said, I think it's intriguing to be able to do things and you get the certain benefits that you can't get with respect to having issuers have direct relationships with their holders. And I know Justin Ando has an even different approach, which I think makes things it opens the markets in different ways.
Yeah, so I'm not a lawyer. And I should also say my comments are my own. And just to reiterate again, I'm no longer a day-to-day Ondo employee, so please keep all that in mind. How I'd like to contribute to this conversation is really to explain sort of who's buying these things and why, and sort of zoom out. And I assure you the vast majority of clients don't even know what any of those terms mean. They do care about things like safety and soundness and those things, and that is paramount.
I care about that from the bank too.
Yeah, so I think when you why are we tokenizing these things at all to begin with? And the real reasons thus far in blockchain are really two things, one of which is happening and the second of which really hasn't happened that much yet. The first of which really is just good old-fashioned market access. People have, via the blockchain, an ability to buy something that they don't have in their normal financial world. So the vast majority of what Ondo is, their clientele is overseas. Obviously, we would love to be involved in the United States market. The United States market is the best capital market. It's going to be the best tokenized capitalized capital markets. But international people don't have the same access to these products, and they are able to do so in a way that they find to be safe and secure via these tokenized products. That's one. That's what's already happening now. Two is you actually need to use the token in some token capacity for the token to be useful. And what this generally means is DeFi. It goes into some sort of protocol and does something that you couldn't have done without the machinery of the blockchain. So one of the things that we offer is the ability to mint and redeem 24/7. So you bring back your tokenized treasury. In that same transaction atomically, you get your stable coins back or whatever you want to redeem into. That's not something you can do in traditional finance. We're still doing T plus whatever settlement, those types of things. That's actually something that the blockchain enables you to do that you couldn't do. Another thing that you can do is you can pay interest on the token, as often as you want, say daily, right, rather than monthly. But really, the point of the tokenization mechanism is that all the legal apparatus needs to get to a point where the tokens really can be used in these novel DeFi protocols to do interesting things. And what the DTCC is doing, the SEFs are amazing. We also need to get the other depositories and clearinghouses to be able to do the same thing, because what a lot of actual portfolio managers in the real world want to do is they have a complex portfolio of multiple different types of assets that are regulated and traded in various different locations. For example, as a portfolio manager, you might get short something via a total return swap with the counterparty of your broker-dealer. That trades in a completely different way than going the old-fashioned way of getting a borrow and shorting something, that type of thing. So really what we want to get to with all of these different tokenizations, all these different products, is really a technology platform where all these things can actually interact in the same way and be truly interoperable, truly usable. And we need to get there, eventually, but we also need to get there together, all stakeholders involved at the same time. But really, one of the really key points of this is that the tokens do need to be used in this interesting DeFi machinery.
I want to keep going here. So that there's a theme here. I think we're seeing under this administration's leadership, and particularly, some of the banking regulators have put out guidance that's really provided a path forward to allow entrepreneurs and existing businesses to innovate using distributed ledger technology. The markets regulators, I think with Chair Atkins and Chair Seelig, both with the SEC and CFTC, are really moving fast, and they're all over this. This week, as I understand it, I believe the SEC put out, I don't know if it was staff guidance or staff statement from Trading and Markets Division that really talks about what you got, a little bit ties into what you're talking about with DeFi. Allows what's called a covered user interface to really be leveraged within certain transactional flows and business activities without triggering certain registration requirements. So what that does is, I think, unless I'm misunderstanding, it allows DeFi to sort of enter the regulatory perimeter in a more healthy and natural way. Do you guys have any thoughts about that? It's hot off the presses and how it ties into it. I was curious to Alex, but we were, open access. I'm a lawyer, but not your lawyer.
But yeah, I guess maybe nominated as the lawyer and someone that worked in the division that I guess that put out.
Yes, you're the appropriate responding.
Yeah. I think, look, maybe putting back on the professor hat here, like if you look over time, there's been a one-way direction in the definition of what is or is not a broker-dealer, right? And it's been always yes, right? And it's always been a more heavy-handed view on what you can, like the obligations of a broker-dealer. And two disparate things that came out that I think are somewhat interconnected is like FINRA also just updated their rule, and FINRA is the National Securities Association that regulates all broker-dealers in the United States. But there's this thing called the pattern day trading rule, right? And so the pattern day trading rule is just this arbitrary artifact of the 2000s, which said when internet trading arose, and there were certain people that were trading in and out of stocks on a pretty frequent basis. And there was a viewpoint, a philosophical viewpoint at the time that was like, whoa, this can be bad. So the only people that can trade in and out of stocks are people with a high balance, right? And that's kind of crazy. But that was the rule, and it's been on the books, and it's been there for 20 plus years because we were scared of internet trading at the time. That just got taken off the books by FINRA this week. At the same time, this guidance came out from the SEC on front ends or the user interfaces, right? And it's pretty expansive in what it allows for. It encompasses, wallets. It encompasses front ends, which are essentially, access points to a smart contract trading system on the back end. And really, what it does, I think, in a thoughtful way, is say why it approaches it from the standpoint of like, why do we have broker-dealer registration to begin with? And the reason you have broker-dealer registration is not because, hey, we want the government to oversee everything. It's because brokers have demonstrated that they can cause problems and harms, right? So when they can misappropriate your funds, when they can, give false information, when they can do these various harms to you, you need to oversee them, and we need to prevent them from doing that. If you look at this guidance, essentially it's saying you need to disclose your conflicts. You can't have discretion over the funds. You can't do these various things that cause problems. And if you're not doing those things that cause problems, we don't need to regulate you like a broker-dealer. The other interesting thing is the duration of this guidance, right? So it's valid for 5 years or until a more durable and firm rulemaking set comes out for this. And so what essentially is it's saying is probably it's giving a safe harbor for now, and it will be codified as a permanent safe harbor for if you do ABC things that provide access to and utility for on-chain activity, and you're not presenting the same risks and harms that brokers present, then you can build and innovate and design ways to interact with that. So I think it's a big step forward, and it's part of this broader picture where the SEC is recalibrating where it needs to oversee things and also enable innovation.
Thanks. I think that was well said. Curious, unless anything else you want to add? Anyone? No?
I think in simple terms, thanks to Laura speak, but for me, in simple terms, is the fact that if you look at decentralized finance, it's a whole different new world. And today, when you place a trade in Fidelity or Charles Schwab, there's a whole accountability of various participants. I think this really making this thing, if anybody provides user interface, we do need to have some accountability of the protocol creators, which was not there in traditional DeFi world. And so it's bringing the same protections that you talk about to the DeFi ecosystem, which is engaging in what Justin mentioned 24/7, financial structures, getting into financial primitives, the borrowing, the lending, the collateral, the collateralization, securitization of these assets, to be able to do all those things at safe and compliant manner in which the investors are protected. That's the intent. So whoever building you can build a protocol, but if you have a UI, then you're supposed to be accountable for that interaction. That's what it says in simple terms, I think.
And I'll just say it's still you can't really do much with what has just come out, right? It's just saying front ends have a safe harbor. They should, I think all front ends should be getting their disclosure ready so they can publish it. But then there's this other thing that isn't really addressed, which is I think they used integrated, but it's blockchain trading system or blockchain integrated trading system. They don't really define what that is, and they don't really define how that is going to be regulated. But that is the actual smart contracts that are handling the securities. And I'm assuming there's going to be more guidance that comes out. There's been, obviously, for a long time, the teased innovation exemption that Chair Atkins has mentioned should be coming out within a month. But I'm assuming that is going to enable some, again, innovation within that space of actually having the smart contract doing what right now would potentially be considered exchange or brokerage activity.
Thanks. So I agree. I think to wrap it up, there's clearly not much maybe that's you can do out of the gate. A lot of this will be determined by where I think Congress lands with DeFi in the legislation that's moving through Congress. But something a little more fun. So we hear about, not that any of this is not fun, but we hear this concept of one wallet. Like have one wallet, you could democratize finance by holding a stable coin we heard earlier today, a real world asset, your fiat cash, all in one wallet, one user interface, the so-called killer app, right? That some people believe. I'm actually going to, Justin, I'm going to throw this one to you to start. Like, where do you think this is in terms of, commercialization and as it relates to real world asset tokenization? I don't know if you have any thoughts about this concept, the killer app, one wallet.
It sounds like a good product.
Is it viable when you have multiple assets?
I mean, I think like there's 150 or 200 companies building this, so like it's obviously sort of a very good idea. Like almost every crypto wallet can hold all the different types of tokens, like not every wallet can connect to every blockchain and stuff like that, but there are standards like ERC-20 for a reason, it enables you to build these tools relatively straightforwardly. I think that I sort of wonder how much individuals really want to manage their own coins and tokens and do all that, on their own. I actually really like all of the financial institutions that I'm a client of. I don't want to manage
all of your children equally.
I think almost all of the traditional financial institutions serve a very valuable purpose that is almost completely irrelevant of whether the thing underneath the hood is a blockchain token or a record at a CSD or whatever. Like the end users, like they just want this stuff to work and they want to be able to do what they want to do. And it kind of like we're all a bunch of finance nerds in here, like we're cool, you guys my people. But like end users, if you're actually building a product or actually building a business, like they don't want to know how the stuff works. They want to be safe and compliant, like you say, but like they just want to be able to do what they're trying to do. If they're trying to get money out of an ATM, whether you bring an ATM card or a QR code or you NFC tap your iPhone, they're just trying to get money out of the ATM, and like they just want it to work and they want to sort of get comfortable with it. But like, but yeah, being a little bit flippant now, I apologize, but I mean, I think it's like obviously a very good product, and I think it's actually not that hard to build, especially these days. But with from a technology, regulatory, compliance perspective, there's all kinds of new stuff in there that we all obviously care about, and it's important to get right.
Anyone else have any thoughts? John?
Yeah, I mean, in the words of John Lennon, you may say I'm a dreamer, but I'm not the only one, right? I mean, I think that it's nice to dream and have this dream of what can be. And I genuinely agree. There's a woman, Sandy Call, who's a thought leader at Franklin Templeton, who talks about this all the time, that we're moving to a wallet-based world. And really, in some ways, the idea is you go beyond the financial assets and instruments that you hold at different institutions and different banks. I mean, if you open your phone today, and if you have whatever your bank of choice, you can see your stock portfolio, your retirement portfolio, your savings account, your checking account, your money market funds. So you can kind of do that today. What you can't do is maybe see your airline miles and other types of things that would fall into a potential wallet structure. But right, no, I mean, it is. I mean, the thing about when I think getting to the point of what you said, Justin, about what people care about, and I genuinely think that there are portions of the marketplace today who care about having that self-control and self-directed assets. And that's what you can do through the wallet structure that you can't do today, right? And I think that's true. I don't know how, it remains to be seen how much of the world wants to move in that other direction. But I also think that there's this concept amongst, I will say, blockchain enthusiasts that you have this trustless world. You don't need to rely on trusted parties anymore. And that's really a myth. And I think that there was a recent hack that demonstrated that there was $385 million that was stolen not too long ago. And so it's just a myth right now. Anyway, maybe someday, again, we dare to dream. And I think about, I've said this relatively recently, if you bought a brand new car and you parked it in your driveway and then you lost your key fob, and so you have this Porsche sitting in your driveway and you lost the key fob, and it was the only one, you have a beautiful looking Porsche that you can't drive. And it would be the same with financial assets and instruments. If you have this wallet, you lose your phone, you lose your keys, and uh-oh. So I think that the trust element will come along where you need trusted parties, or in whatever form it happens to be, to help because they provide a value-added service.
So I would say one thing on that. So how many of you have Coinbase account here? Few of you, right? Coinbase account, right?
Reluctant.
So two things. Two things.
Delayed response.
Two things with this, right? One is this whole notion of, so to me, wallet is an accounting construct. It's happening today. It's called Super App, where you have all your financial sort of transactions in one place. So if you have Coinbase account, Coinbase has announced, like Ondo mentioned, Justin mentioned with Ondo, is some tokenized securities, prediction markets, commodities, getting into crypto. So you have all your financial sort of assets in one place, allowing you to move the assets, trade the assets, and deal with, which what we do today, you have micro market structures. So for your securities, you go to a different entity. For your commodities, if you're dealing with some gold instrument, for example, you go to different. So you have all these different micro market structures that makes it complicated, because that's an evolution of a financial system. When you tokenize an asset, a token is a token is a token, and you're getting into this transactionality of it. So I think where Tom is touching upon is this debate of custodial versus non-custodial, like, hey, do you want to own that wallet and manage it yourself? And chances are most of them, for one, finance is boring, even for financial people, even though we may be nerds. But for common people, they don't really care. They want some assurance, they want some guarantees. So I think this embedded wallet, which technically is an enormously complicated concept, and to Justin's point, there are 50 companies trying to do that. I think that for them to be able to amalgamate all their financial well-being into one single application, whether it's Fidelity application or Coinbase application, I think that's the future. And the back office infrastructure that we are talking about here makes that easier and simpler, because no longer you have to deal with financial micro market structures, because everything is in tokenized form. I think that's where the puck is heading. I don't expect people to have their own keys. Yes, Porsche example is great. I don't think people have their own. I myself, even though I've been in this industry for a long time, I don't like to manage my own keys.
I drive the Kia, by the way.
Oh, okay. Yeah. I did the train.
So I'm conscious of the time. I got two questions. I put them together. Two questions sort of to wrap this up, and each of you can choose which one you want to answer quickly. But is there any one thing that any of you, each of you sees that could truly unlock mass adoption. We're just totally bring it to market. Like think about, bringing music on digital channels, moving away. Or also, if you can give one piece of advice to someone who wants to get into this space, we do have students here, what would it be?
I guess I can start.
I had a feeling you grab the microphones. That's
Yeah, so I think my advice for those people is you should probably just go into AI. I've been sitting here listening to panels all day long, and I've been in this business for maybe a little bit too long, but I think I'm going to take the over on all of the bullish predictions of when the banks are going to be, doing all the transactions and stable coins. I take the over on all those. I forgot what was the first part of that question.
I think you.
Oh yeah,
I think you
the game changer. Yeah. I think you probably can already guess what my answer is going to be. It's going to be user experience. The vast majority of people are not going to want to manage their own keys. They kind of want a wallet, but they're not going to put their Porsche in their wallet that's on their phone. That's, we don't walk around with our 401k in our wallet in real life either. But I really think that for normal people to get to the adoption point, we need to come up with something that makes this stuff safer and easier for a regular person. And then, trying to explain this to, my girlfriend or my father or whatever, I mean, their eyes glaze over within 10 seconds. It's all about user experience, right?
So I have two elements. So I have a master's in AI, which is obsolete because it was a long time ago. But we've been working on AI for the longest time. It has this ChatGPT moment. It took almost 27 to 30 years to get to this point. A lot of technical iteration that happened, and now it's ubiquitous. Everyone's doing a few things. The innovation has been exponential. It's seeping into all aspects of our lives, all aspects of every single industry sector, and so on and so forth. Let's switch back from this traditional asset, which is the last 15 years of what I've dedicated my life to in terms of understanding the market structure, understanding what we need to invest, the technical aspect of it, working with the largest financial institutions in the world there is one angle of transformation. So we are changing the way we transact with assets by tokenizing them, efficiency, going after some value chain compression, lower fees. All that is great. But that's not it. I think that the real adoption comes from incentivizing the right users. So UI, UX is a great sort of first start. But I'm thinking that we are building this financial infrastructure not to just tokenize securities and bonds and commodities and trade them in and out, but it's inching towards the new digital assets that's emerging. Your data, for instance, as AI emerges, your data becomes more valuable. You absolutely have no control in data. But if you could monetize and control the data, would you not leverage that possibility? So there's our impact, which is a central bank agenda, Federal Reserve is here, of inflation and job creation. So what happens with AI when it actually encourages your job? So what is the solution? There's a solution like UBI or a solution like data. If you can monetize your data, does that not augment? So once you begin to give those incentives, and let's say I tokenize my data, you have access to the data, you'll find the ChatGPT moments. Now, because we are moving away from securities and bonds, which hardly anybody understands, but people understand their ability to earn, their ability to monetize what they have. So I think that's where my future state is, that until you get to that point, blockchains will still be an enigma, still be a black box, will be for large institutions and so forth. I'll pause here.
30 seconds for you two guys, because I think we're at time.
So I'll try to be quick, but I think about the airplane, and it was 400 years from the time that Da Vinci made the drawing to the time that the Wright brothers took off. And it was another 10 years before the first commercial flight took off, and there was one passenger on the plane. And so I think that we're probably at that moment now. But what's important to me is actually, I think that the user experience is right, both from a retail standpoint and an institutional standpoint. The motivation, and so that's something that we're working on heavily to make to have the integration with institutions so that it can work more seamlessly, and something we're very conscious of. But there's also the benefit that comes from using the technology that people are recognizing in a real way. There was a study done last year by an independent company that suggested that financial institutions can save $1 billion a day by leveraging blockchain technology for the purposes of moving collateral around. And there's a realization that that's happening, and now the motivation is there to start writing the checks to build the solutions, to build the integration, to make it happen.
And I'll just echo, even DTC's dominance took well over a decade, right? With from its inception in the late 70s until the late 80s, there was 5%, 10%, and then 80% by the end of the 80s of securities were dematerialized at DTC. So even when the adoption curve is always going to be longer than you think. My bearish case is we just have better collateral. My bullish case is we actually have differentiated utility, and there's a more true form of ownership that you can have. I think probably it's going to be some combination of that, but I agree with everyone that says it's going to be all about the UI. And once that's truly unlocked, we're going to look back and say, wow, it was always here, but it's truly unlocked.
All right, so with that, I want to thank panelists here for joining, and we don't want to stand in the way of the demonstrations coming up, so, but thank you.